Good morning, I'm Chris Beach, and welcome to Charting the Markets on IG Live. It's a fairly cautious open for European markets, and US futures also looking a touch weaker. After a better day yesterday, particularly for the US, which did see some gains after, it has to be said, a poor finish to last week. But undoubtedly, despite a decent session yesterday and strong showing in Asia overnight, it does look like we've got some hesitation setting in ahead of tomorrow's US inflation reading, which is perhaps probably the key event of the week. We've also got earnings season, of course, really kicking off on Thursday and Friday. US banks begin reporting on Friday as normal at the start of earnings season, but that's really the key driver, I think, the inflation reading from the US this week, because, of course, we came out on Friday with that very strong payrolls report, and that has undoubtedly sent a signal that the Fed has space to continue raising rates if it so wishes. So whilst we did have gains for stocks yesterday and signs of recovery in risk appetite, things are looking a bit dicier today. It looks like everyone's just beginning to hunker down really ahead of that US inflation reading tomorrow. Also this morning in major news, you've had UK employment figures, which have really been, I think, the anti-Goldilocks. We often talk about a Goldilocks piece of data if it's not so bad as the spook markets, but bad enough that it might lead to cut in interest rates. Today has been the anti-Goldilocks because you've had a rise in UK wages, once again, strong rise in UK wages, but also a rise in unemployment. So it shows not only does the Bank of England need to tighten more because of the rise in interest rates that's driving inflation, but also that maybe the first signs of weakness in employment figures are beginning to show through. So that's why I think there's a bit of caution, although you wouldn't actually know it in the pound this morning, which is once again on the up against the US dollar. Starting with the indices and beginning with the FTSE 100, currently trading down at 72.47. That's roughly around the lowest level since the middle of March. We're all the way back to where we were during the height of that banking crisis, if you can cast your mind back to Silicon Valley Bank, JP Morgan, Credit Suisse and the rest, when there were fears about the banking crisis. So it's interesting that the index has suffered so impressively. You've had, of course, plenty of strength in the pound. A lot of caution there coming through about the Chinese economy as well, which has hit the FTSE 100 quite a bit. Also weakness in commodity prices. So we found ourselves really having taken quite a big lurch to downside over the past week. We've lost about 250 points in the index and no sign of it turning around yet, although the declines have unsurprisingly slowed as we've neared this zone of support really around 72.50. You can see there really that March's low took a while to form, and we went all the way down to 7,200 really before it then bounced. We're heading in that direction, but there's no sign as yet that it's formed another low. For that, we'd have to see a close back above 7,300. That would be a positive development, would mirror the bounce off that zone that we saw in December of last year. I think for the moment, it looks like we've stalled the declines, but certainly it's very hard to muster a positive view for this index, which after all has been declining steadily since the end of April and has registered essentially what has been not quite a straight line move, but mostly a straight line move to the downside since then, with no sign really of any sustained recovery. Of course, we're below the 200-day moving average, most notably, of course, a textbook attempt to break back above the 200-day at the beginning of July, then failed and essentially set the groundwork for this big slump we saw. So the FTSE 100 still very much under pressure. Below 7,300, it's hard to be particularly bullish in the short term, really. Barring some kind of impressive rebound at the moment, it does look quite like a fairly negative outlook for this index. Looking at European markets, slightly better, although the DAX as well stumbled on Thursday, last Thursday, to its lowest level since the beginning of April. But what looks essentially like maybe something like a consolidation, really. Very hard to make sustained gains since then, really, for this index. And crucially this morning, we tried to break back above the 100-day moving average and failed. We are also, of course, back below 15,000, well, certainly around 15,700. The actual line of support resistance was 15,709. So we're just below that. A failure to move on above that level would, I think, be a relatively negative development because it was so important as resistance on the way up, and then even more important as support all the way through April, May and June. And now it's broken to the downside. It broke last Thursday. The attempted rebound has really stalled, and that does then send a potential warning signal that if it then reverses back below 15,500, maybe you've finally got another deeper pullback here for this index that takes us perhaps back to the 200-day moving average and close to the lows from March as well for this index. It's still broadly in an uptrend, it has to be said, but I think at the moment it's just struggling in the short term. Undoubtedly with the US CPI on the agenda for the week, that's not helping matters either. And to US markets themselves, the Dow staging a very impressive rebound yesterday off the 50-day moving average, which mirrored what we had in the latter half of June, when the index reached 33,600, 33,650 and the 50-day, and then rallied and then moved higher. So yesterday did give some hope to the buyers that maybe they can stop the selling around this level and set up another attempt to break 34,500, because that's the line in the sand here for any upside. Two attempts since the middle of June to break that level have failed. So the index is beginning to find itself in something of a trading range, certainly up to 34,500, back down to 33,600 and so on. At the moment, we're rallying back up again. So you could, for example, look to trade the range by buying it with a stop all the way below here. It's quite a wide stop, but that's it with the Dow. And could take us back on 34,500 and see whether it can then finally manage to muster the strength to break out above that level. But as ever, US CPI squats on the calendar and just sits in the way of everything. And of course, if that weren't enough, you've then got US earnings season beginning. So there is plenty going on for US markets, which the Dow has, of course, been one of the weaker performers this year. The S&P and the Nasdaq both much stronger because of the great importance of tech in those indices, whereas the Dow is not so important in terms of the weighting. So that's why it's a weaker performer. But it has at least avoided any more significant downside, which is certainly not the case as we saw for the FTSE 100. Looking at FX markets, euro dollar on a high once again after last week, really giving quite a lot of strength, risk appetite turning in quite a positive fashion for euro dollar after a brief pullback here that saw it test the 50-day moving average on a number of occasions, but showing no real desire to go below it either. It did dip below it, but just about closed below it twice and then rebounded, and then finally found the strength to break out again of this negative pattern. Perhaps can call it a wedge of some kind, and then move on back to its, in fact, today it's so far touched its highest level since the beginning of May. So a firm bounce there in euro dollar seems to be putting the buyers back in charge here. And then this leads us on to see whether we can move the price on to these highs just below 111 that we saw in April and May, with the buyers coming in around 107 and so far holding up very well and pushing on to see whether we can then clear that level and head on towards 111 and revive the uptrend. Back on above there, of course, a higher high would give a firm boost to the overall move higher for euro dollar. Despite, of course, expectations that the Fed will continue to tighten policy, it is the general view that the ECB will have to tighten even more than the Fed. So that's really what's driving euro dollar at this point in time. Of course, the focus was on the UK data this morning and that strength in UK wages, which really sends a signal that we need more hikes from the Bank of England, which is not a pleasant prospect for mortgage holders to contemplate. But back above 129 for the pound against the dollar for the first time since April of last year. So the round trip continues here, clawing back these losses of 2022 and earlier, really, for this one. A new higher high clocked up just after last week's dip here to 126. Buyers really coming in to defend this level in quite an impressive fashion. So this is a key one to watch out for, really, that the pound has really showed a lot of strength coming through here. No sign of that abating at the moment. And just as we talked about with euro dollar breaking out of that downward pattern over the past week, pound has been even stronger than that, and now sits at a higher high with the uptrend firmly intact. The next big target really comes into play around 130, an interesting level of support in March 2022 before it broke. So that's the next big one to look out for, really, for the time being. And then dollar yen, which has finally taken a bit of a knock, and an impressive one at that. No explicit sign that the Japanese Ministry of Finance has intervened, and nothing that I've seen so far, but it does make it look like it, or at least the net effect has been the same. Uptrend, but a pullback towards the 50-day moving average, a very sharp decline. That classic adage of markets, that they fall 3 times as fast as they rise. In 4 days, in 4 sessions of trading, we've wiped out all the gains made since the first half of June, almost all the gains made. But it's still in an uptrend. It was new higher high at the end of June. So this is perhaps the kind of thing the buyers are looking for. I think the pullback, it was dramatic, but it's something to be expected. And see whether it stabilizes perhaps around the 50-day moving average, or in this zone of support around 139, and then starts to move higher again. It's certainly with the price above the 50-day and the 50-day above the 200-day, it's hard to muster a particularly negative view of this one in the short term. Commodity prices benefiting from a weaker dollar this morning. Certainly gold is anyway, back above the 1932, the 1930 level that's been so important, really. A little bit of a fake breakout to the downside, it appears. As ever with markets, they don't do anything in the way that people expect them to. Dipped below 1930, but stalled, rather selling stalled around 1900. We found ourselves recovering, and now we've got a recovering MACD, certainly back above 1930, provides a more positive signal, I think, and suggests that perhaps this downward move has run its course. We also find ourselves back above these trendline resistance levels, particularly this one from the May high, which we broke last week, and then also the one from mid-May that we're now beginning to push above this morning. So the buyer's back in charge. That perhaps sends a message that we've now got more room to move to the upside, maybe towards 1960 in the 50-day, or even higher than that, really. The buyer's definitely coming in to defend this one, and the bearish case, which we thought might have happened with a close below 1900, certainly cancelled out for the time being. Oil prices, they've had a really good run, and unsurprisingly that has slowed, not necessarily turned firm to the downside, but it's interesting. Certainly remained fairly cautious in the outlook for oil all year, and so far it has continued to be fairly mixed at best. Certainly no attempt to really break higher, certainly not above the 200-day that we saw in April. And as I did say last week, we looked at the 74 level. It's been such a big area since the middle of May. Gains have really stalled once they got to this level, and here we are again, and at the 100-day moving average. We haven't rolled over yet entirely. That would need to come with a move back below 72 perhaps, but certainly sending a signal that the sellers are trying to rest back for this one. Back below 72 would certainly be the negative development. Back above 74, and then might send a signal that maybe we're about to see another test of the 200-day moving average. But for the moment, perhaps this is the interesting thing to watch, is that maybe if we get a stronger dollar tomorrow from US CPI, there's no escaping it, then maybe that will push oil back down again and give us a negative signal with perhaps a bearish MACD crossover as well, sending the message that perhaps the sellers are back in charge, and maybe we see another move back down towards the 67 level, which has been support since the beginning of June. So not much on the calendar for the rest of the day. It really is the warm-up to US inflation tomorrow, which I might have mentioned a couple of times at least, and you'll hear plenty more of later in the day, really. We're still looking for some slowdown in price growth tomorrow, and if that is the case, maybe it will give risk appetite a bit of a lift. But as I also said, once you get past CPI, you've got US earnings season to contend with, which will certainly dominate things for at least the next couple of weeks until the banks and the big tech firms are out of the way. But that's it from me. Thank you for joining us. So expecting a slightly weaker open for the Dow this morning after its very strong run. It's attempting to move higher, but certainly some indecision really creeping into US and indeed other markets as we await that US inflation reading tomorrow. But thank you for joining us. We'll be back as normal tomorrow at 10:30.